Good morning, my name is Przemysław Kwiecień. You're watching XTB weekly trading webinar. So today we are going to discuss a little bit about bull and bear markets, how to try to navigate economic cycles and stock market cycles, which data to pay attention to. But traditionally we start from the top news, and the big news on Monday morning, certainly Turkey and the Turkish lira that was down at one point even 16% after President Erdogan fired his chief of central bank, which is not the first time when it happens, but to add to the in how dramatic this situation was, it happened right after central bank increased interest rates from 17 to 19%. So obviously from the global point of view, markets are not very happy with this, because that means that not only president once again questions the monetary policy and the independence of central bank, but does that in a very direct manner. So some investors are right now fleeing Turkey. Well, right now, if you look at the chart, obviously the first reaction was a complete panic, and Turkish lira against the dollar, it moved nearly to the highs that we had at the height of the weakness of the lira from last year. Right now we are seeing some attempt to cover some of these losses, but obviously we should brace for increased volatility in days to come, because we don't know what's going to happen with monetary decisions right now, right after the change of the head of the central bank. We can have, for instance, a reversal of this interest rate decision, and that would be very bad for the currency, obviously. So this is a big news on Monday morning, and it's going to dominate markets for some time. Going further, we have a conflict between EU and the UK on AstraZeneca vaccine exports. Well, that's important for markets because, as we are saying in previous weeks, the pound was doing very well on high rate of vaccination in UK, whereas in EU it's looking way worse. And if you look at the euro pound currency pair, it was actually moving quite steadily towards the lower limit of this very broad consolidation starting from the Brexit referendum, and there was a good chance of this pair reaching this lower limit at around 0.83, whereas obviously any major setback in vaccination in UK could be a factor prompting some profit taking from the pound. So this is important to watch. Then we had FOMC and BOJ meetings last week. We're going to discuss this in a minute, and calendar for this week. Two key points are PMIs on Wednesday and US inflation expectation Friday. We're going to discuss this in a minute as well. So yeah, let's discuss this actually now with this Federal Reserve meeting. Well, it actually didn't result in big changes. If you look at forecasts, which had to be adjusted because of this Biden package, they adjusted growth upwards, unemployment rates downwards. But what's crucial here is that they said, look, we are going to have higher inflation, but just a bit above the target, and that will allow us to maintain record low interest rates for a few more years. So even though you can see here that we have some range, and comparing to December, there is a slight risk of rate increase next year. Actually, you need to bear in mind that this is because of the board of the FOMC composition, which where you have few presidents from local districts, and they are usually more hawkish, whereas the board with Powell, and they decide over interest rates, they are always more dovish, and they want to stick with 0.1 until the end of 2023. So the message was, look, we want to have higher growth, higher but still acceptable inflation, and we can go full speed with our monetary policy. So this was what helped markets on Wednesday. And if you look at S&P 500, for instance, back then we had record highs, yeah, and only market turned lower on Thursday. So but this is the other story. But on Wednesday, after the FOMC, it was business as usual, positive reaction, and a move towards 4K. We narrowly missed this, but obviously it's still possible that we get there during this cycle. Moving on, big moves on the DAX. The German index was at record highs again for many days last week, and only on Thursday, Friday we had kind of hesitation here. As you can see, a move towards the upper limit of this channel, and the big news was Volkswagen shares that exploded higher after the company said we kind of want to be a European Tesla. And what's ironic here is not that it's not European investors that flocked into these stocks, but US investors through ADRs that are quoted in the United States. They started to purchase the company like crazy. And yeah, once again, I think it's a good proof of how hot, how overheated the markets are these days with this extreme monetary policy in the US and checks and everything. And as you can see, this contributed nearly 200 points to DAX this year. So it's a pretty big move, and obviously it's interesting to see how it's going to evolve. But definitely, if you are DAX trader these days, you need to watch what happens with these shares, because they are having so much impact on the market. And then finally, from the last week events, BOJ meeting. And what's important here is that the Bank of Japan signaled that they are no longer that sure that their monetary policy, which was absolutely crazy after over the past 8 years, where they were buying tons of bonds, and also as the only major central banks, they were buying stocks, ETFs. They actually tightened this policy as slightly, allowing for some increase in bond yields and not declaring a certain amount of ETFs they are going to buy. So yeah, from the economic perspective, this policy was a complete failure. They failed to reach anything. Inflation, as you can see, it stayed as low as it was before. Economic growth actually was even weaker for our years. So obviously, this is a big warning to other central banks that this policy is not going to work, and the only lasting effect will be higher share of central bank in any market, but the economic consequences will be very, very doubtful, to say the least. And yeah, we had Nikkei reacting to this, obviously, but the reaction so far, I would say, was measured. It wasn't very, very large yet. Obviously, we had 2 days of declines, but nothing more than you saw on the global markets. So you have the Nikkei 225 here moving down, but if you compare it, not even to March last year, but let's say to October, November of last year, it's still so much higher. But if the Bank of Japan follows through on this meeting, and actually if they start shrinking their purchases of the ETFs, it could be obviously a very negative impact, a very negative factor. All right, so let's move to the topic of the week. It's a very complex thing, so I wanted to go quickly through it to just give you an idea of what am I looking at in terms of trying to assess when to increase a risk of stock market portfolio and where to let some of the air go out if I think the markets are too high, too overheated. So basically, what you would like to do obviously, we have these bull markets, bear markets, and you would always like to buy at the bottom and sell at the cycle high, which is nearly impossible, obviously. But if you are active investors, this is your goal ultimately. So in ideal world, you would like to have some kind of indicator telling you where the bottom is and where the high is. And this indicator, if it were about to work, it would need to be it would need to look like this, right? If it would need to be very regular, having some value at the bottom and the same value over and over again, regardless if the correction was 15% or 50% bear market. This indicator would always need to be at the same level, because otherwise you wouldn't know if that's low or not. Obviously it's not possible, and there is no indicator like this. So what we are left with is a set of indicators that are very, very far from perfect, and we need to try to look at them together and try to have some sense of where the market is and what should I do with my portfolio. So maybe I start with drawdowns and market rallies, because this is the entry point for me. If market is sliding, this is what I'm looking at. This is 2-year drawdown, which is a market decline from a 2-year high. And as you can see, this is for S&P 500, because you have more than, as you can see here, it's more than 70 years of the data, and obviously US markets are dominating globally. So if you have a global portfolio, like even if you are not investing directly in US markets, but you have some global portfolio, like let's say ETF for MSCI or something like this, it's going to be 60% US. So it still makes sense to look at this from that perspective. So as you can see here, you had many drawdowns of about 20%. So already you have a hint. Okay, 20% is a good starting point to decide whether I should do something. And then you had some obviously large bear markets where you have these drawdowns between 30 and even 50 some percent. So obviously these drawdowns are not regular, because market is not regular, but at least you have some indication. 20% or around 20% is your starting point, and if market slides, let's say 15% plus, you should start watching around and think, are there any other signs of market being oversold? Should I increase market risk in my portfolio via stocks or indices or ETFs? And this a similar approach works from the other way around. Here we have 2-year rallies. So this is a 2-year advance from a market low, and as you can see here, there is a bit less of regularity. Some of the cycles ended at about 40%, some had 60%, and there were a few above 80%. So this is why it is actually harder for investors to exit the position rather than to enter them from the strategic point of view. It's because as you saw here, this is more regular. This, like again, we see about 20%. It's our starting point, and then if this is really a larger bear market, it's still, I would say, roughly between 30-40% most of the time. Whereas here, it can really vary by quite a lot. So it already gives us a hint that we cannot make it a 0-1 decision. And usually what we want to do is to split this decision into few steps. And let's say here, well, we have 40% rally, and then we are looking at other indicators. Are they suggesting the market being overheated or not? If they are, well, we can reduce a risk of our portfolio by selling some of our stocks, or by hedging them with, let's say, futures or CFDs on indices. If this is not the market peak, and this indicator goes to 60%, then we can look again. if the other indicators suggest the market is again it's overbought, we can again reduce a risk of our portfolio, and so on and so forth until the 80% measure, right? What are these other indicators? Where there are some that are working better, there are some that are working worse. One that is usually those that look the most convincing are actually not working that well. Among those, there are price to GDP, which you can see is at all-time high right now, but as you can see, this is very far from being a regular indicator. Or you can have price to earnings, which again, according to the Bloomberg data, is at all-time highs for S&P 500, but again, it's not very regular. Or price to sales, which again is at all-time highs by a very, very huge margin, but here's a shorter history, so it's only about 30 years, but again, it's way above previous highs from the dot-com bubble, but again, there is no regularity. So these measures should only be supportive for you, whereas the other measures like options market, where right now there are very few put options and a lot of call options, and again you can see a similar situation occurred at the pinnacle of the dot-com bubble. Or investor sentiment, where investors are now decisively optimistic, which is usually a contrarian sign, or some kind of deviations from 2 years average. For me, 2 year is working the best, and again you can see that very often the cycle ends with this measure above 20%, or similar deviation from in this price to GDP ratio, and again at above 20% upwards or 10% downwards below the average is the first signal that occurs. Or you can see look at the VIX index. So there are many of these supporting, I just showed a few, there are many of these supportive signs that tell you that if a primary condition, right now we are obviously not looking at drawdowns because the market is not after a large correction, but we are looking at the 2-year rally, which approaches 80%. So it's already past 40, it's past 60, it's approaching 80%. So we are looking at the other factors, and if they are suggesting the market is overheated, then obviously it makes sense from this approach to reduce a risk of our portfolio and to wait then for a drawdown and increase it once again. Obviously, it's not going to work 100%. It's not going to work precisely because markets are not precise in from that perspective. It's not physics where you can calculate a formula and it's going to work very in a very specific way, like you can arrange some space mission to the moon or to the Mars, and you need to calculate everything in a very tiny detail, and it needs to work, and it's gonna work if you do that well. It's not like this with markets, because here it's a lot of psychology, here's a lot of changing conditions, economic or policy conditions, or like with the central banks these days. So you need to prepare that it's not going to work in a perfect way. But if you want to manage your portfolio around stock market cycles, this is probably better than nothing. Okay, let's move to what we have this week. This week is in the calendar is not looking as busy as last week when we had the Fed, BOG and the others, but still few, at least 2 days worth watching. One is Wednesday, where we're going to have PMI indices for March, and what I would pay attention to here is that US is once again outperforming rest of the world, and this is already seen on the euro dollar, where we had attempts to move higher after the FOMC last week, but it didn't work eventually, and we have a situation similar to this one, and this might be just an indication that we are still in this longer downward scheme, and yeah, right now it doesn't look very bullish. So look for these indicators. If they once again show outperformance of the US, it could be interpreted like this. And then on Friday we're going to have PCE inflation in the US, which is not going to be very interesting, because PCE, obviously the Fed watches this, but it's being released one week after the CPI. So the CPI usually gives us a good idea where the PCE is going to be. So the markets are going to look more on the inflation expectations part of the University of Michigan survey, which is going to be released at 3 p.m. CET on Friday. So here you wanna see especially these 5-year expectations. If they are going to rise along the 1-year expectations, this is going to impact bond yields, and obviously this has a lot of impact on many markets, including gold, which saw rebound from this strong support point. However, as we discussed last week, this rebound was fairly weak in terms of pace, and with bond yields still increasing, which means bond prices declining, the outlook for now is not very favorable, and it's a similar story for silver. So yeah, certainly everything that relates to inflation in the US is important for markets right now, because these worries are still there, and for as long as bonds are declining and yields are increasing, it's not a good sign for precious metals. So bear that in mind. All right, so ladies and gentlemen, that's it for today. I wish you a good week. Please remember that we are covering markets for you in the news section of Xstation mobile platforms. So please stay with us and let's see each other on next Monday, 7:30. Have a good day. Have a great week. Bye.